been a real estate investor for over 10 years now. And I've been a short-term and vacation rental real estate investor for right at 10 years now. As a real estate agent, my company, The Short-Term Shop, has helped over 5,000 people buy and sell short-term rental investments across 20 markets, multiple states for almost as long. So I have seen a lot of short-term rental action over the last 10 years. And in 10 years of doing this full time, I want to talk to you about what really happens and what I would do different with my portfolio and investing strategy with the knowledge that I've gained over the last 10 years. When my husband and I bought our first short-term rental back in 2015, there were no roadmaps. People on YouTube telling you how to do this. There were no people on Instagram, TikTok. There really wasn't any data either. AirDNA, I think, started the same year that we started, and it was extremely expensive, and if it did exist, we couldn't afford it. So the times have really changed. There was no property management software. We had to do everything remotely. Answering messages, scheduling cleaners. I had to open my calendar at the beginning of every month and write out every single day that our cleaner had to go clean and make sure she got it. I'd email it to her, I'd text it to her. I would show her the calendar and I'd also write it out so that there was no way she could miss a clean. Also, if there were any holes in the calendar, I'd have to watch those like a hawk every single day. And if somebody booked, I'd have to make sure I let my cleaner know immediately so that we didn't miss any cleans. Doing it manual back then was really different than it is doing it now with all the property management softwares that we have. We had to self-manage back then because it was a 40% split to property management companies at that time. That was very standard for the Smoky Mountains. And our goal was to build a business, and we didn't have enough money to pay somebody 40%. We needed that 40% to go buy more real estate. So we learned to self-manage just out of necessity, and we had to teach ourselves. There weren't courses, there really wasn't anything. We had to just trial and error, figure it out as we went. So back then, it wasn't about systematizing and scaling, it was about survival with the property that you have. You learn as you go, you fix what breaks, and you keep moving forward as best you can. So back then, it was not about scaling. It was just about survival with the properties that you have. We had to learn as we went. If something broke, we had to fix it, and hopefully we would get enough bookings to keep the mortgage paid in the meantime. So looking back now, that cabin really taught me more about business and operations and investing than any course ever could. And there are tons of courses out there that I could go and buy that will not teach me as much as I learned that first year of owning our first rental. It taught me resourcefulness, it taught me adaptability, it laid the foundation for everything that my company, The Short-Term Shop, would eventually become. But we're not talking about my company, we're talking about my investment. Let's get into it. So between 2015 and 2017, we were able to scale our short-term rental portfolio from 1 cabin in the Smoky Mountains to 5 cabins in the Smoky Mountains. And back then, the properties were only $150,000 for a 2-bedroom. And I know people hate to hear that these days, what shoulda, coulda, woulda. The best time to buy real estate was always yesterday, but second best time is today. You could just really hop on the MLS back then, and any property just laying around on the MLS, you could slap it up on Airbnb without really doing anything to it, leave it grandma, and have a 20% cash on cash return. The early adopter phase of vacation rentals was really wild. The early adopter phase, for those of you who don't know what that means or not familiar with that term, it's a part of any industry where there's more opportunity than there is competition. And the thing about early adopter phases in any industry, they end. The early adopter phase is not real life. It's just a moment in time. And all industries typically have an early adopter phase, and then the bell curve kind of goes up like this, and then it goes down and things kind of stabilize. And that's what we've seen over the last 10 years of investing in short-term rentals. Even back then, investors that we knew or investors that we came across told us we were crazy. They told us it was way too late, that ship had sailed, that we should have bought prior to 2010 if we were going to be successful with short-term rentals or really any type of real estate investing. So everybody told us we missed the boat. Does that sound familiar to you? Because everybody's still saying that today. There's always somebody I've found in every time period, every part of the economic cycle telling you that you're too late. We spent 2015 through 2019 just slowly building our portfolio, buying a few short-term rentals, buying a few long-term rentals, and in 2019, things started changing before COVID. I think a lot of people think that COVID was the big change bringer, and it was. It was definitely the turning point, but things really started ramping up before then. I would say 2018, 2019 is when the big rise kind of started. So people started realizing that you could just buy any old property in a vacation market and slap it on Airbnb and make a bunch of money. And you could, that was real life back then. So people started doing that slowly. And then 2020 rolled around. And by that point, I had 5 short-term rentals, and we had about 40 long-term doors duplexes. When COVID happened, we thought that everybody who was telling us we were crazy, we thought they were right. Oh man, the other shoes finally dropped. The short-term rentals are finally gonna go away. Like, this is not gonna be good. We're gonna lose the short-term rentals. But we were really happy though. We felt very taken care of because our long-term rentals, we had 40 of them. So if the short-term rentals were about to go down the toilet, we at least had our long-term rentals to support us while we were getting the short-term rentals back on track. You know, however long COVID was gonna take, we didn't know. We thought the world was ending. We were Lysoling our Chick-fil-A on DoorDash. It really was a crazy time, but luckily it was just about a month in the markets that we were in and our short-term rentals boomed. And so we thought, whew, we don't have to worry about the short terms, but then it was the long terms that we had to worry about because the eviction moratoriums started happening. At least we have the long terms. The short terms are gonna go down the toilet, but then the pendulum swung back really quickly and we thought, well, thank goodness we have the short terms because if these eviction moratoriums allow our tenants to not pay rent, then we're gonna have some problems. But luckily we didn't have any evictions during COVID, but it felt really good to know that no matter which way that pendulum swung, that we were in good shape because we had a diverse portfolio. Nowadays, I don't really know a lot of investors who invest in multiple types of real estate. Most of the ones that I know either do all short-term or all long-term, and they think the people who invest in the other type of real estate are crazy. So one thing that we did right that I would do again is to make sure that we are diversified across multiple asset classes, not just asset classes, but multiple markets, so different locations as well. So that's something I think that we've done really well in our portfolio up until now. Okay, so let's go back to the short-term rentals during that 2020 initial COVID time. So tourism actually really surged during this time, and that's not what we expected. Everybody wanted to get out of their houses. They were dying to get out of their houses, but they didn't want to go to hotels and be around other people, and they didn't want to get on planes and be around other people. So they went to regional, drivable vacation markets within, under a 10-hour drive from their homes. And once travel kind of reopened, we didn't see the tide go out on that tourism surge for several years. So that tourism surge stayed around, I would say, until 2020, end of 2021, beginning of 2022. During this time, it was kind of a perfect storm between surging tourism and extremely low interest rates. So this was a kind of a hurricane of high incomes and then a lot of buyers jumping in at the same time and bidding each other up on properties. So because rates were historically low, we saw on the real estate sales side in my agent business, sometimes we would have 100 offers on a listing. And it was really insane, and people were bidding each other up to insane prices on these properties. And we knew it wasn't sustainable. I think everyone knew it wasn't sustainable, but everyone wanted to get in and get that low interest rate to secure a 30-year fixed mortgage, which we're the only country in the world that has that. 30-year fixed mortgage is probably one of the top 5 things about being an American in terms of being able to build wealth. And a lot of people understood that, jumped in and bought properties. A lot of people bought properties for reasons that they shouldn't. They heard 2% interest. What's the payment on that beach house? Oh, I can make that. Let me buy that and let me slap it up on Airbnb. And we were some of those people. We bought a lot of real estate between 2020 and 2023. We bought short terms, we bought long terms, we bought multifamily, we bought a little bit of everything because we remembered that at the beginning of COVID, how taken care of we felt by our prior selves by diversifying our portfolio. So we continued to buy multiple asset classes. We scaled up to 8 short-term rentals. We bought 2 more this year in 2025. So we've got 10 now, and we have several hundred apartment building and duplex stores as well. So we bought a lot of real estate during that time. So yes, we grew our portfolio during that COVID rise quite a bit, like a lot of people did. And then tourism started to dip back down to more normal levels. It stabilized. And here's where I think a lot of people get it wrong in terms of short-term rentals don't work anymore, people selling their properties. So I think a lot of people who talk about this online have not owned real estate long enough to really have seen a full cycle. So did our income go down on our properties between 2021 and 2022? Yes, it did. However, the properties that we've owned since 2015, those properties, let's take one for example, we underwrote to do $45,000 a year. At the height of everything, it did $90,000 a year. But once that tourism stabilized, it dropped to $75,000 a year, and it has, I don't want to use the word stabilized again, but it has remained stable from 2022, 2023, 2024, and it's looking like 2025 as well. It stayed in that between $75,000 and $77,000 a year range. So very predictable income nowadays. And here's the part that I mentioned that people get wrong. Yes, income has gone down since 2021. That is not a secret. Everybody on the internet likes to holler about, oh, well, rents are down in that area. Well, down from what? The peak? Yes, and there can only be one peak. From the entire dawn of time to the end of time, there will only be one peak. And you will be successful in real estate whether you own during that peak or not. You will only have one best year ever, no matter how much real estate you own and no matter how many doors you own or how long you own them. So for us, what we saw, because we've owned for so long, was yes, we did have a peak in 2021. We went from 45,000 to 90,000 down to 75,000, and we've stabilized at 75,000. So we're still trending upwards over time. We had a dip, just like everybody, but we've owned real estate so long that we're able to see that. And so, 10 years is nothing compared to other people, but it's still trending upwards. We're almost double, a little less than double what we underwrote for in 2015. So it's not timing the market, it's time in the market. The longer you hold your real estate, the more you will be able to see that upward trend in both income and value. So people who bought in 2020 and sold in 2022 missed the stabilization. It seemed like a crash to them when really it was just a blip, and at least in our portfolio, everything's still continuing to trend upward. So all that to say, I can understand why some people who bought at the height of things might say that short-term rentals don't work anymore, or that rents are down, or short-term rentals don't make money, but they've only seen half the cycle. You have to own real estate for long periods of time to really see that income growth and that wealth building happen. Real estate is very much a get-rich-slow tool. And I think in 2019 and 2020, a lot of people on the internet, a lot of podcasts, a lot of people giving advice, making regular people think that it was a slot machine, that it was get rich quick. You can buy one or two properties and quit your job, which a lot of people have done. But is that smart and is that conservative? I don't think so. So what we're seeing now is not a collapse. It's a return to normal. It's actually a return to well above normal. It's just a stabilization. So we can all calm down. Things have been a lot more predictable over the last 3 or 4 years, and I think they're going to continue to stay predictable for a period of time. So even after all that, we're still earning almost double what we made 10 years ago. So just hold your real estate, guys. That's another thing that I think we've done well in our portfolio is we have held real estate and we haven't sold or traded around too much and really burned up our equity. Something else that I think really is something that we did well, which I'm going to get to things we didn't do well in a minute, but was being careful not to over leverage ourselves. You can take out HELOCs and leverage properties against each other, and if you've got a lot of equity in one property, pull that out to go buy another one. And we didn't do that. We stayed conservative, even though we really went into a heavy buying mode. We didn't leverage properties against each other. We didn't take out HELOCs. We let the properties that we bought to cash flow sit and do their jobs, and then saved the money to buy the next property, rather than trying to go too fast and building a house of cards, leveraging our bottom, older properties. So I think where we have shined in our portfolio is not leveraging our older properties to buy our newer properties. The older properties are cash flowing great. I want them to continue to cash flow. So I'm not going to pull that equity out to raise that LTV. I don't want to raise that LTV to where I'm cash flowing less just so that I can buy more properties, because that's kind of a wash. So for me, I don't leverage properties against other properties. I let the properties stand on their own to make their own money, and I don't use them to acquire more. I save to buy the next property. We saw a lot of people during this 2020 to 2022 timeframe leverage all their properties against each other, and all it took was one property to stop performing. Sometimes, by no fault of the owner. Maybe something weird happened, maybe an accident, maybe a fire. If that property stopped performing, then the whole house of cards came tumbling down. They have to sell everything for a loss. So my advice to y'all is to not over leverage. I know if you've got a bunch of equity, it can seem like a good idea to, well, let's pull this out and go buy 4 more. Well, look at what that's actually going to do to your monthly cash flow. Because for me, we started buying real estate for cash flow. So I don't want to diminish the cash flow of my older properties that I'm leveraging against to buy new properties. I want them all to be able to stand on their own and do what they need to do as their individual investments. So that's another thing that I'm proud of the way we have handled so far, is to not over leverage. You'll always hear a lot of advice to use other people's money to leverage your properties, pull equity out. That can be a great way to scale, but there is a really fine line between leveraging and gambling. So make sure you stay well on the leveraging side and don't get going too fast to where you lose the forest for the trees and you just get what we call door disease and want all these doors, but you're not paying attention to what it's doing to your equity, what it's doing to the rest of your portfolio. So things are gonna happen, bookings are gonna slow down, bookings are gonna speed up, regulations are gonna change, but flexibility is what keeps you in the game as a real estate investor. So real estate wealth isn't real estate built on too much leverage. It's built on margin, patience, and cash flow, and just persistence, patience, keep that cash flow there because that's the reason that you bought it. Something that I've learned over the last decade is the importance of systems. We've automated everything that we can within reason. We don't want our guests to feel like they're not talking to a human being and they can't talk to one if they want to, but we use tools like Hospitable, Price Labs, TouchStay, and we use all of these things to help us streamline our portfolio. So I would say it takes the same amount of time using these tools to manage 10 properties that it took us back in the day before we had all these tools to manage one property. So automation is okay within reason. It's not autopilot. If you put a property on autopilot, then you're going to miss things and your income is going to suffer. So even though you have these great automation tools that have really streamlined our business, they've really springboarded our income as well, you have to manage those systems. So just because you have Price Labs doesn't mean you don't have to look at Price Labs every day and look at what it's doing and make tweaks if you're not getting booked. One of the biggest mistakes that I see people making is they say, hey Avery, I need you to look at my listing. I'm having a hard time getting booked. I'm not making enough money. And I'll say, well, let me look at your pricing. And they'll say, well, I don't mess with pricing. I have Price Labs. That's mistake number one. You manage your systems. They're not there to replace you. They are there to help you. Leverage your systems. Don't let them run your business. Here's the key though. You have to start systems at the right time. You have to start them early, but not too early. Because if you start trying to systematize everything before you actually know how to manage your property, then you're gonna make mistakes and your income's gonna suffer. You learn the business for the first 6 months and then start implementing tools and systems to streamline. And you'll know from managing 6 months plus, you'll start to see the pattern in things that happen over and over. If it happens more than 3 times, you build a system around it. You build a standard operating procedure around it. If 3 guests ask the same question, you figure out a way to answer that question before they have a chance to ask, because they've exposed a hole in your system and you need to fill it. So systematizing is very important, but you have to learn the business first. You can't put it on autopilot, and you learn what to systematize by managing your properties. And just as important as the management side and managing your systems is choosing the right market. So what I have learned over 10 years of doing this and helping other people doing this is we've always bought in established high tourism volume vacation markets. The Smokies, Gulf Shores, Destin, 30A, these are places where the tourism comes to you. When you buy in a location where the tourism is already coming to you, you don't have to go crazy with hundreds of thousands of dollars on amenities. If you're buying in the right location, the tourism's coming anyway. Location wins over amenities every time. So we saw a lot of people in the boom trying to buy properties too far away because they were cheaper, they were easier to get, there weren't as many people competing to get them. And then they'd add a whole bunch of things and they'd say, well, I'm making my place the destination. And that worked fine during the COVID tourism boom. But once the tide went out on that, those types of properties were the first to start underperforming. So my advice is don't try to reinvent the wheel. Dollywood's already there. Buy a cabin next to Dollywood. Don't try to invent Dollywood over here in a cabin too far away from things, because people are always going to come to Dollywood, and if you give them the proximity and the location and the convenience, they will stay in your property. So cute, clean, comfortable, updated, but you don't have to go nuts. Buy the worst property in the best neighborhood. Don't try to buy the best property way out in the sticks, because that's not going to work anymore. That's not sustainable long term. Because when you buy where people are already going, you don't have to fight for demand. The demand is already there. So location over amenities every time, but it doesn't hurt to add a few amenities, of course. A cute, clean, comfortable property in the right location will outperform an over-engineered one in the wrong location every time. Now, I do want to be transparent about the mistakes that we've made, because we have made some. On the long-term rental side, we bought some apartment buildings in some cheap Midwestern cities because they were cheap. We said, oh wow, it's so cheap here. We can buy tons of things and the cash flow looks great. Why are these things not all bought up? And so we bought a few cheap properties and we owned those for a few years. We still own a number of them, but we had one in particular that really taught us a lesson. We owned that property for about 4 years. And when we bought it, everything was fine. The property across the street steadily started to decline. I don't know if it was bad management, the owner ran out of money, I'm not sure. But it started to be a lot of crime, started to be a lot of drugs, and then eventually the property was condemned by the city. And over this course of time, that crime started moving across the street to our property, scaring away our good tenants. They're breaking our windows, they're vandalizing, and the crime is just kind of sucking. And let me tell you something, the police do not care about your landlord problems. So over time, it just got to be too much of a drain on our energy to keep dealing with this, and in a property where nobody really wanted to live because the condemned building across the street and all the crime going on. We sold that property for a loss. The reason that those properties in that area or in the Midwest in general are so cheap is because the Midwest doesn't really appreciate. The reason it doesn't appreciate is because it's not a desirable market. Not being desirable, I don't mean it's the wrong side of the tracks. I mean, there's not industry bringing people into that area to live. So because people aren't moving there, the real estate stays cheap, it doesn't appreciate, which is why everything in the Midwest is so cheap. We ended up having to sell that property for a loss because no appreciation. And even if it had just appreciated 3 or 4% a year, we would have had enough cushion to kind of get out from under that without coming out of pocket, but we didn't. So that was a big lesson for us in buying cheap real estate. Just because it looks good on a spreadsheet doesn't mean it's going to be a good investment. And you really do have to take the time when you're buying any kind of real estate to understand, let's say in short terms, who comes to that market, why, where they're going when they get there, and making sure you're buying in the right part of, not only the right market, but the right part of the market. And for us, that was an expensive lesson, but it's one that was worth learning. So I'm able to tell you, if a spreadsheet looks too good to be true for the way the market as a whole looks, I would look a little bit further into that, into the more nuanced side of the real estate and not just the very qualitative numbers analytical side, because you can have a spreadsheet that looks great and a piece of real estate that just sucks all your money away just because you bought in the wrong area. So the lesson there is that spreadsheets don't tell the full story. You have to learn everything else about a market before you invest. Don't invest just based on spreadsheets and numbers, or you might end up in a situation like me. Now, where we really succeeded in terms of location or short-term rentals was sticking to true vacation markets. So we weren't trying to disrupt the hotel industry by buying in metro markets or chasing trends. We're simply buying in places where short-term rentals have existed for decades, a century even. Mountain towns, beach towns, national parks, lakes, places like this. And because of that, we are actually in what I would call more of a century-old established subset of short-term rentals, vacation rentals. This is an established asset class. Vacation rentals are different than short-term rentals, in my opinion. Vacation rentals have been around for centuries, and we weren't disrupting anything. We were just tapping into an already established asset class and kind of modernizing it with the use of technology. And I think the vacation rental industry has matured far beyond the hype of Airbnb in 2020 and 2021. You know, old model of going into cheap neighborhoods and buying your grandmother's house or a starter home and turning that into a short-term rental just to make a little more money than it being a long-term rental. I think that's over. I think that part of Airbnb and short-term rentals is dead. But I think the vacation rental industry still has plenty of room to run because we have, I would say, an innumerable amount of markets like this. Beach markets, mountain markets, national park markets, like I mentioned, where it's been the normal thing for tourists to go rent a single family home, a cabin, a condo overnight, then a hotel. And I think that there's still plenty of room. If you go on Airbnb and look at the listings, even in markets that have tons and tons of listings, only like 10% of them are actual sophisticated operators. I would say 90% of them are still on these big old dinosaur property management companies or your mama and papa who have it on Airbnb but aren't really quite sure how things work. So there's plenty of room to be successful, but you just have to be more persistent in finding a property and being able to get it at a purchase price that makes sense. So after 10 years, I can tell you this. You don't have to chase the next trend to be successful in the short-term rental market. Stick to what is tried and true, which has been going on since before Airbnb, before the internet in a lot of cases. Here's what you have to do. You have to buy right, you have to finance right, and you have to manage right. If you do those three things, you will be successful. And I think people really mess up on the buy right, they mess up on the finance. Financing right means don't use a $500,000 HELOC on your primary home to buy a bunch of short-term rentals. Save up and buy what you can afford without leveraging your primary home where you live or your children live, or without leveraging existing short-term rentals that you may have. Don't over leverage. That's part of financing right. It's not just, oh, I got this great loan with these great terms. Where's your down payment coming from? If that's coming from a place that is not sustainable, you're not financing right. So we're buying right, we're making low offers, because as it stands right now, the prices laying around on the MLS are not necessarily the price that is going to work for you as an investor. So be patient and persistent. Go out there and make low offers until you find a property that works at the price you're able to get it for. The way the market is right now, asking price is just a suggestion. I've been making offers on the same property for about 4 months, and finally the seller, it sat there, finally the seller came back to me and said, hey, okay, I think I'm good with your original offer. It's been 4 months. So sometimes you have to let the sellers, let the market tell them no, and be patient, be persistent, make those low offers. You never know if a seller has gotten 10 low offers already, and here you come with low offer number 11, and you get a deal that makes sense numbers-wise for you. And you finance that right, not over leveraging yourself, and then you manage it well. You don't let the systems manage you, you manage your systems. So when it comes to real estate investing, you have to think long-term. It's not about quick wins. Look at my portfolio. 10 years. We're almost doubling our income now than what we underwrote it to be 10 years ago. So it's not about quitting your job next year on the 2 properties that you bought this year. It's about building a life with freedom of time, 1 property at a time, over time, not overnight. So if you're new to short-term rentals, here's my advice. Don't get distracted by social media noise. You don't need 10 properties to be successful. You just need 1 good one in the right market, at the right price point, managed the right way. From there, you build your portfolio and you build your wealth. So start small, learn the systems, understand the guest experience, buy in a market that you know and understand, because knowledge is going to be your competitive edge in a competitive market. So buy in an area where you know who comes there, why they come there, what time of year they come there, and what they come to do. That is going to be your competitive edge for you to be successful when it comes to choosing a market and being successful in short-term rentals. Make sure you're buying somewhere that you would want to visit yourself, because it's easier to market a product that you like than one that you don't. If you love it, chances are other people are going to also. And when you're ready to start, the realtors at the Short Term Shop are here to help you. You can find out more information about what we do at theshorttermshop.com, but we've helped over 5,000 investors buy and sell just under $4 billion worth of short-term rentals, and we've taught every single one of them how to manage remotely to be successful, to build their portfolio and generational wealth. Thanks for watching, and here's to the next 10 years of real estate investing.